You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from theoptionsinsider.com, and co-hosts Alex the Viceroy Jacobson from Options Express, Uncle Mike Tusaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi, and Mark the Greasy Meatball Sebastian from OptionPit.com. The Option Block is brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, everybody, that rockin' tune means it is time once again for the Option Block, everyone's favorite bi-weekly source for all things options related. A little bit of wit, a little bit of wisdom, a little bit of analysis, a little bit of education, a little bit of insight. Sprinkle it all together, mix it up, stir it up in the old cauldron, and you get the Option Block. My name is Mark Longo from theoptionsinsider.com, as well as from the Options Insider Radio Network, upon which hopefully you're listening to this fine program right now. If you're listening in some other outlet that's linking to our stuff, that's fine too. We don't mind. And of course, if you haven't checked them out, make sure you check out the latest additions to the network, including Options Playbook Radio, where we break down a lot of options, techniques, and strategies, and some interesting sports metaphors you may be interested in, as well as Trading Tech Talk, where we break down all of the amazing tech that is powering your trading these days. And of course, while you're checking those out, make sure you check out our brand spanking new mobile app available for iOS, Android, and indeed Kindle Fire, all the different platforms you can name. Don't have a Windows Phone version yet, but if you guys use that out there, Windows Phone 8, let us know. We can maybe cook up a version for you guys as well. A lot of great stuff. Check it out, the Options Insider Radio Network app. I think you're going to like it. All right, and joining me on the old all-star panel today, starting off with the man beaming in the closest proximity to the old Options Insider HQ, none other than the Viceroy himself, Mr. Alex Jacobson from OX by Charles Schwab. Mr. Viceroy, welcome back to the show, sir.
Good to be here today, Mark. Not a lot going on today. We talked a little bit before the show, and I talked to the desk, and I shared the comment with you, but they said that everything today was Apple, Amazon, VIX. It's just funny. Grigas made the comment that we could have delisted all the equities above the letter A today and not impacted what was going on much. But it was actually a very busy day in Apple, and folks are trying to figure it out. So lot to talk about today.
I think there's quite a few people in the brokerage sphere who agree with that sentiment. You could pretty much delist everything from A South, maybe a toss in Facebook and a couple others, and that's really about the lion's share of what you need on any given day. All right, and also joining us from the great state of Maine, you know him, you love him, as the hot skater himself, none other than the Rock Lobster, Mr. Andrew Giovinazzi. Mr. G, I'm guessing the hot skate weather not too favorable these days up in Maine.
More like hot roller skates, but I'm not really a roller skater guy. I can only handle one skating activity at once, so I'm loosely what I could call ice skating when the winter time comes. maybe a video will come up one day, watching my children skate around me like I'm standing still. But that will have to wait for next winter.
I can somehow picture you in the pink elbow pads and the knee pads out there with the roller skates. It's an interesting image.
But with the cross-country skis too, there's a lot of that. We have a lot of that here because we have some trails that go along some of the rivers, and there's some cross-country skiers in the summertime. So, I'm kind of in the summertime. I'd rather do the summertime activities, like kind of boating and fishing and swimming. But once the winter leaves, I kind of leave the winter activities.
Not too much of a winter activity mecca here in downtown Chicago, but we are still a bit of an options mecca. So let's get right to it with the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
All right, and as Alex alluded to, it wasn't perhaps the most captivating day from a broad index perspective. We are recording this today, listeners, on Monday, June 2nd, for those of you playing the home game out there who love to know the dates. And it was essentially unched across the board for most of the major indices. Q's closing off a little bit, S&P closing up a little bit, Dow closing up a little bit, but nothing really to write home about in any of the major indices, as VIX cash also taking a bit of a tick up, about 1/10 of a point to about back to the old 11.5 range, pretty much vacillating around that range for the better part of last week and continuing that again today. As Alex alluded to, a lot of the action was in the A names. Amazon down about 1.2% or nearly 4 handles to 308, about almost 309. And Apple down about 0.75 of a percentage point to 628.65. Of course, a lot of that belies the intraday activity that was going on in a lot of these names. Apple having a total of about 12 point, nearly 13 point range on the day. So a lot of action coming in. We've talked on earlier shows last week about how it seemed like the iWatch rumors and all the other stuff leading into the big developer conference was really putting us back on the bullish trend here for Apple. Seems like perhaps some of that coming off today, the bloom perhaps a bit off the rose. I'm guessing today, Mr. Andrew, that a lot of the pre-market talk for you guys and a lot of the chat in the Option Pit chat room was Apple-centric. Am I way out of line?
Nope. We spent the morning chatting about it, looking at like short-term Apple flies for prior to the split. Kind of vol was higher this morning. And those, I think, did okay. By the end of the day, they look really good. Looking at even short time spreads to hold maybe through the split in case you're waiting for a who knows what to happen. Yep, we certainly we looked at it, talked about it. So we came up with a couple of good ideas today. So they worked out okay. It's too early to tell on the short time spread, but it's moving in the right direction with the wall coming in, so that can't be a terrible.
All right, listeners, and we can't get into Apple territory, can't start talking about Apple without welcoming on this man, Mr. Uncle Mike Tusaw from RCM Wealth Advisors, the resident Apple zealot here on the panel. Or should I say representative of many Apple zealots. Uncle Mike, welcome back to the show, sir. It has been too long.
Oh, it's always good to be back here. Yeah, it went down a little bit today, but good gosh, since the last time I've been on the show, it's gone up, that's for sure. Curious to see how things are going to react going into the split coming up here on, let's see, that's today, isn't it? The split mark?
I think it just happened right after the close, so if you haven't adjusted for that already, Uncle Mike, you probably should get to that right now.
Oh, got it. I'll figure it out. There's special after-hours trading on options on Apple, so now...
Yes, just Apple, I believe. Only Apple.
Yeah, so now that the regulators will probably throw me into jail for saying such a thing. No, I think that it's a little bit of a down day today, but I'm curious to see how it'll react. Number one, going into the split, and then number two, with all the data that we have coming out this week, to see how Apple can either swim against the tide or possibly go with the tide, or we'll see. It's going to be an interesting week.
And just to clarify for our listeners who may be scratching their heads saying, what the heck are they talking about? The actual split is coming up next Monday, listeners, the 9th. So if you're worried, if you're scrambling to make your adjustments right now, you still have a little bit of time. Speaking of adjustments, Uncle Mike, what have you been doing? What have you been up to out in the great fruit company known as Apple? What adjustments do you have on? What are you prepping to do ahead of the split, ahead of the big conference this week? Or are you kind of just riding with the stock and long put again?
Riding the stock and long put again, not trying to get too cute. I think we're going to have some good movement on it. So we'll see what happens.
All right. And Mr. Viceroy, you alluded to it a little bit earlier. You said the A names were taking up pretty much all of your day today and the day over there at the desk. What in particular did you notice about what was going up in the old A names, and perhaps any other activity that may have caught your eye over there at OX?
So a couple things. First of all, in volatility in VIX and VIX futures, it's gotten to the point now where nobody is buying the expectation of a downside. It's gotten to the point, we're talking about this because I occasionally will join a customer conversation if they're a very large customer or a customer who wants some clarification. And I think I've said the word term structure probably 50 or 60 times in the last week, explaining VIX pricing. But there's just this concept that there's no way VIX can go any lower, and everybody's trying to figure out, should they buy the 17.25 call spread? Should they buy the 19.26 call spread? What's the best way to get the vol out of it? But all the conversations with VIX and VIX futures have been to the upside, which of course convinces me that vol in fact will go lower because of the consensus contrarian view. The other thing that's been keeping the desk busy is explaining the Apple split and what it'll mean and how it will adjust, and what will your portfolio look like a week from now after the split. So somewhat giving the volatility advice, but in Apple, a lot of housekeeping, and a lot of people seem to be playing the concept that post-split there's going to be a lift from the split. So that's what was keeping everybody busy today. Amazon has come back on the radar screen, and we talked about this on Thursday, how Amazon had kind of a stealth rally as one of the momentum names. Now, obviously, it lost ground today with the momentum names, but a lot of conversation about Amazon, and Amazon still has a ton of supporters, and it's still that stock that you do the what if. If you bought it on IPO day, it's amongst the best performing stocks currently out there, actually better than Apple. But that's what was going on today.
You're right. We could fill the entire network, and indeed the entire Options Insider website, with, is the VIX too low? When will the VIX pop? When will the VIX pop? Of course, we have our show, Volatility Views, that comes out every week, dissecting that in a lot of great detail. I encourage listeners to check out the latest episode. Just came out Monday morning, so by the time you're listening to this, one day ago, where we get into a lot of interesting data, a lot of the media back and forth about this, including some interesting data that our friend Jared over there and Klineman and a bunch of other research outlets saying the skew in the S&P perhaps not reflecting that sentiment to a great degree, even though everyone's saying essentially, oh, it's so low right now, it has to pop. The long-term average, quote-unquote, of the VIX is 20, so it has to mean revert back to that level. We've kind of debunked that a little bit here on this show quite extensively on the Volatility Views program, but you're right, we could fill the entire show with this kind of talk. Just looking right now, I saw something that caught my eye today. They were writing about it on, I believe it's called Bespoke Investment Group, talking about their analysis of the VIX, saying since 1990, the VIX, of course, VIX cash is what they're referring to, listeners, has been at its current level or lower just 4% of the time. They also say that in 2012, the index was around 14, and today it's at 11.5, as we just mentioned. So I thought I'd do a little bit of homework while we were talking here just to see exactly where the good old S&P was exactly 2 years ago. And if you do that look back, do that look up, listeners, it's pretty easy to do. You'll see we were roughly 600 points lower in the S&P than we are right now. So even if you're a relative options novice, look at the S&P, look at the skew, and say, you know what? Kind of makes sense that maybe we're a few handles lower than where we were 600 points ago in the S&P. That's the kind of stuff that drives me crazy about all this banding about VIX cash in the broad media. They put no context at all to that actual VIX cash number. It's just a standalone number that they bark out all the time. And when you look at it in context, clearly there's a lot more grist for the mill there. Mr. Andrew, I know you write quite extensively about VIX and what's going on out there. You do quite a few blogs for Option Pit and others. We publish a few of them on Insider every now and then. What's the latest take over there on the blog about all this constant drumbeat about the VIX is too low and it has to revert back to the quote-unquote moving average of 20?
Well, like I said in my blog today, the absolute level of VIX is pretty low. It's been lower, but it's definitely on the low side. You only got 1.5 more points for all-time lows. But from a relative point of view, which is how we kind of teach our students at Option Pit, the relative level is still, relatively high because the market's not moving. You've got to realize vol of the S&P 500 is like 7%. So it should be where it is. That's the point. It's saying when the market's moving 3% per day, it should be trading 40 VIX. So, I mean, all it is the VIX is a reflection, one, of where options are trading now, but where people think they're going to trade. And every time, as time goes on, we've taken out a couple of big things out of the big movement question. Like one is the Fed is bailing on supporting the economy, basically. So that is, let's call it a big upside stimulus when they used to kind of jump in and say, oh, we're going to do this or this. And we'd have those 1 to 1.5% point rallies or more, or like 2.5% over 3 days, which were great for all the longs. I loved the fact that the Fed has done all this stuff for my stocks, but that was a big piece of upside volatility. I don't think that's there anymore. Second is, the imminent demise of the euro and the U.S. government and Fannie and Freddie and all that stuff. Fannie and Freddie is all of these things, like slowly but surely, are just, it's one less disastrous thing that people seem to be taking off their plates. So there is just less need, or there's less interest in buying tons of puts. The third part is just upside. People are going to start writing calls again as investors start buying underlying. They start writing calls. Funds will start writing calls more, and that presses the volatility down a little bit because all of a sudden there's a supply of calls. A call writing strategy was pretty tough in 13, but it doesn't look too bad this year, because you've had, a little bit more jaggedy up and down movement. So all these things, like taken together, sort of push the VIX down. Federal deficit is half of what it used to be, or what is it, a third of what it used to be, I think. So it's like you have all these like little tiny, kind of macro factors that just take away some of the worry. And the VIX can stay at, in a 13 to 10 range for 2 to 3 years. Every once in a while it'll pop up to 14 or 16, but it can stay that low. So it's doing all the market's doing all the things it needs to do to ring up a low number. So that's the state we have. So until this pattern changes, unless the economic data gets really bad, or the market stops shrugging it off, something along those lines. We seem to have baked in the Russian thing, the Syrian thing, and everything else. So we're going to need some new whatever. So the question is what is that going to cost for you to buy that kind of, that kind of protection? Because right now, it's implied volatility, even in the vol products, is relatively cheap, but you're paying a high relative price to the at the money for it. So it's even if you go there and think it's cheap, it's not as cheap as you think. So, and I think vol is well priced at this level. This is where it should be. And without something awful happening, this is where we're going to stay for a little bit. I could see the 11 to 13 range kind of stick around for a while, possibly trade the 10 handle if the non-farm payroll number is halfway decent. Everybody's like, oh, okay, so we're creating jobs. What are we worried about? And that's how those numbers slowly get lower. It's kind of like your golf score. If you're improving in golf, you just don't pick up a 1 stroke per week in your handicap. You kind of, you improve in plateaus, and that's kind of how vol trades. It sort of plateaus and then tanks, and then plateaus and tanks on the downside. It's slower moving down than it is moving up.
There's a lot of this drum beating going on out there. A lot of it, I think, I hate to ascribe motive, but a lot of it, I think, originating on behalf of the product owners and other people who have vested interest in these products actually trading on a regular basis, looking out there saying, this number is pretty low. We want to get some excitement, get some enthusiasm out there. Let's start perpetuating this long-term average of 20 again and beat that drum that the VIX has to mean revert. A lot of these articles hitting on that. None of them really seeming to touch on the carry cost that could be involved in a trade like that, because as we've said many times on this show, and anyone who's been around the S&P for a while knows, vol could stay in this range for quite some time. All these people beating this drum, it's got to pop. Look at VIX back at 20. That could take quite a long time if it indeed does happen. And if it happens, it could happen very slowly. So you can find yourself rolling extensively and very expensively over the near term. And God forbid you want these people out there just loading up on VXX, hoping for that near term pop back to 20, because we've beat that drum many times on this show that is not perhaps the way you want to go. One last thing before we wrap up the old trading block here. It is that time of the month. Yes, it's volume time. All of the big exchanges and outlets are announcing their options volume for the month that was May. And today the OCC, which is the Options Clearing Corp, announced that the total contract volume that they cleared in May was about 319 million contracts, an 18% decrease from May of last year when the volume was nearly 400 million contracts. Year to date, the OCC cleared volume still remains up for the year. It's about 1.8 roughly billion contracts, 1% higher than at the same point last year. So that early part of the year, all of that Ukraine and everything else feeding back into the market, we saw some aggressive vacillations in the marketplace, of course, that fed into the early part of 2014 at least. Q1 in particular being very strong from an options volume perspective. A year-to-date OCC's ADV, the average daily contract volume, up about 2% to 17.37 or so million contracts a day, and daily options volume also up about 2% to 17.1 million contracts. So there you go. The numbers overall not looking so great when you're looking at year to year, but then again, early part of the year, very strong, still kind of carrying us through what was a relatively lackluster Q2. We'll see if Q3 can really get the ball rolling with a little bit more volume, a little bit more action to speak of. Speaking of action, it's time for us to keep on rolling right on into our next segment. It's time for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody, welcome to the Odd Block. This is, of course, the portion of the show we break down the weird, the wild, the downright bizarre activity that we're seeing lighten up the old tape from an options perspective. Going to kick things off since we started the show saying how it pretty much was an all Apple day. We'll start off with Apple and go from there. Of course, Apple closing the day, like I said earlier, down about 0.75 percentage point or so to 628.65 on the day. Apple, don't need to tell you guys, Apple quite the volume leader of late, averaging about 400,000 contracts, or just shy of that, doing 532,000 today. So a very, very strong volume day for good old Apple. Now, what we saw today wasn't the biggest volume trade by a long shot, but this is the one trade we chose to highlight out of the myriad going up in Apple today. If you looked at our site, you saw June 640, 650 call ratio, the good old call 1x2 making a return appearance here in the old Odd Block, and they chose to do it in Apple this time. It went up 1,500 by 3,000 times, roughly 4,500 contracts or so. It went up in two blocks, traded the 660s on the sell side, and most likely the 640s scooping up on the old buy side. This is the kind of trade you might see going into an announcement like we have coming up this week, and maybe some other developments later on, where someone, perhaps a long equity holder, wanting to perhaps increase that long premium exposure. This is also referred to quite frequently if the stock's taking a bit of a dip as a repair trade, but there's no reason you only have to limit it to that repair scenario. It also works pretty well in an underlying that you're expecting might have some upside movement sometime in the near term. Uncle Mike, we'll start with you. since you're the Apple devotee amongst us, what's your take here on someone coming in and loading up on essentially this 1x2 here, 640, 660 in June? Do you like it? Do you agree with it? Are you thinking about adding it to your own portfolios?
Don't know if I'd want to add it to my own portfolios, but just in looking at it, I like the strategy. What this entails, this is a way with which I like to think of this as kind of like a covered call trade that you want to be aggressive on. So I'm under the assumption that this person actually does own the underlying. I would think he does. You never know. But with that, as you do this, of course, the limit is that you're not going to make anything past 660, but you're increasing your leverage on the stock between the 640 to the 660 level. So I like the trade in general, but it's one that you have to have the mentality that you don't think that Apple's going to go past 660 going into this announcement. And if you're fine with that, then this is a great trade.
This is a strategy you find yourself using at all with your clients, your mentees out there? We talked about it a lot on the odd block a lot, but never with you, Uncle Mike, and particularly with Apple or some of the other underlyings you like. And we talked about repair strategies in the strategy block before. Is it something you like to tack on, perhaps a little bit of a kicker for some upside where you got, like you said, a limited expectation of upside and you want to perhaps double your exposure or increase your exposure to it?
I love this strategy. I think that this is a way with which a lot of times I try to make it to where it's an even money strategy. I've done this strategy for a debit before. I've done this strategy for credits before, but usually my general rule is I like to make it around even money. If you're getting too much of a credit, then that's usually a stock with which it's going to be too much of a high flyer for my tastes and my clients' tastes anyway. And if you're doing it for too much of a debit, then, well, by all means, you might as well just buy the calls themselves. So I love this strategy in general. I'm looking to do it in the near future with gold at some point, ironically, that you bring this up. I don't know if Apple's the right fit for what we're trying to do right now, but the strategy itself, I think it's a great strategy.
Very much in keeping with your trading style, the Goldilocks trading style, Uncle Mike. If it's too rich, then you know something's wrong with it. And if you're paying too much, then you don't like it. It's got to be right in the middle for you.
Gotta have it. Gotta have it.
All right, Mr. Rock Lobster, what's your take here on this 1x2 going up in this little company you may have heard of called Apple?
Yeah, I think it's somebody that owns the stock because it would be it's not a small, it would be like $92 million of, from an equity point of view, kind of owning 1,500 or 150,000 shares. So, you'd have to have a pretty good sized pocketbook to put this trade on in the first place. So it's looking like a long stock guy just wants to add a little gas to the upside. It looked okay. Potentially could be a play on that upside. So, but I didn't. Do I like the trade? I mean, it was a way to sell some volatility, and I think it ended up doing okay by the end of the day because it was short some deltas per contract. Even though it traded for a debit, it had a slight short delta at the outset, and the vol came in. So, but as this trade in particular goes, it's not one particularly jazzed on going into the stock split. It's the gamma. The movement is so unpredictable after a split. I prefer not to have a lot of short contracts in there. So
yeah, he's definitely playing with a little bit of fire here going into the old 7-for-1, which, as we said, is happening as we speak, listeners. So prepare yourselves. All right, next up, moving on from apples to figs, we have Fortress Investment Group, ticker symbol FIG or FIG. This one closing today, $7.23, up about 13 cents or nearly 2% on the day. This is the name that does about 1,300 contracts a day. So not exactly Apple-esque from a volume perspective, doing about 11,500 contracts today. Pretty much all of that coming in one sizable, I guess you can call it, is it a roll? Is it a sale? We'll dig into a little bit and find out, listeners. We saw activity going up on the Jan 2015 and 2016 seven strikes to the tune of about 3,400 or so, going up on the 2015s for prices in the 80 to 90 cents range, and about 7,531, 10 more than the open interest on the Jan 2016 seven strike. Those going up for about $1.30 to $1.50, so a bit of a range on those as well. Most of the volume, again, looking like it was selling, at least coming in on the 2015s. And looks like early selling in the 2016s as well. So there could be someone who had scooped up both of these and perhaps now is taking the opportunity to lay some of those off. Again, the open interest on the Jan 2016s was 7,521 contracts. So pretty much all of that closed up. 5,600 open on the Jan 2015. So only a portion of that being closed up. So that your take as well, Senior Andrew? Is this a double close or is this a roll out, if not up?
Yeah, I think it was so much selling. There was kind of aggressive with the seller on the 2016s, left the offer out there and they slowly got filled during the day. I just looked like a lot of closing paper. At the time that I saw this going up, the number on the open interest and the 2016s, the numbers were exact, volume to OI. I guess 10 more got added.
Someone piled in with a 10 lot just to screw up your perfect analysis, sir.
Exactly. So an extra 10 lot came in. So it just looks like, somebody probably scooped this when Fortress was in the, like this low 6 handle. And it's since bounced back over the last couple of weeks. So probably maybe taking some easy money. If they were long it from any other time, I don't know how they would have done, but it's just by and large, just mostly just selling premium on both those strikes. So most of it's sold on the bid. I mean, what what couldn't be sold was eventually lifted once the stock ran. So somebody it feels like it wanted to get out, or we're going to see a big chunk of open interest tomorrow. That effectively all those open interest numbers will double. So it's worth a look. I don't think the guy's buy writing this though.
You think it's just the old Tusa-esque time stupid that he's closing out here?
It's a stupid on top of a stupid.
I love it. All right, moving on to Ed Asner's favorite name. This is ASNA. Ascena Retail Group Inc., ticker symbol ASNA, closing today $16.53, down about 1% on the day or so. This is the name that does about a little bit shy of 1,000 contracts a day, doing about 7,500 today. So a decent volume name here for good old Ed Asner's ASNA. And what we saw in particular that caught our attention in good old ASNA was a little bit closer to home this time in June. The June 17 puts going up when we profiled it on the site 3,218 times for $1 even. After we profiled it, a few more went up to the tune of 4,000, nearly 4,100. The open interest on that strike is 45.87, so still not the full OI, but pretty darn close to it. The early chunk that we profiled went up in one block. The other stuff went up scattered afterwards. It looks like this is a closing put by. Earnings are coming out tomorrow, actually, after the open. So on Tuesday the 3rd. So this looks like someone putting on a bit of a spec. It went their way. Stock's down a bit south of the 17 handle since they put this on. And now they're taking their money and going home before earnings. Kind of like the old Andrew Giovinazzi, get your free gamma, take the money, and go home type trade. Mr. G, I'm thinking that you're a fan of this one.
I think you want to take your money and go home. I mean, the stock's trading at a low level. You got earnings out, you're short them. Unless you want to take a position in the stock, you could definitely be owning it. So I think it's definitely worth closing a short position out and go along your merry way.
All right, all this closing talk here in the old odd block. We'll do one opening to take us home. This is Western Union. I haven't talked about this one in the odd block in quite some time. Ticker symbol WU, closing today almost $16 even, down a little bit, down about nearly 1% on the day today. This is the name that does about 3,300 contracts a day, doing a whopping 10,000 today. So an aggressive day from a volume perspective out here in good old Western Union. And what caught our eye in particular was looking on out to August. The AUG 16s going up quite a few times. When we profiled it, it went up 9,035 times. A few hundred more went up scattered afterwards. That volume we profiled went up in one sizable block. The OI is about 2,500, so this is clearly opening any way you slice it. Looks like probably a buy writer and opening to boot, so we got someone here trading what is essentially an at-the-money buy right. Pretty aggressive, but not too bad. taking about 60 cents to put this position on through August. Not bad if you're into Western Union, want to take a little bit of yield out of this name in the next couple of months. Mr. G, take us home. What you take here on this aggressive, pretty sizable buy rider here in Western Union?
Yeah, I mean, I think it's like a good top of the market trade. You just want to, WU isn't really moving too much anymore. It pays a 12.5-cent dividend. Just looks like a dividend capture with the short call, but it's 4.5% through August for what, 3 months, June, July, August, less than 3 months. So, if you can make 4.5% every quarter forever, you'd be doing well.
That isn't the way you trade, Andrew?
I'm doing a little better than that this year.
All right, that's going to do it for Western Union. It's also going to do it for the odd block for this episode. And now we're going to keep on rolling. It's time for the Viceroy to don his festive cap because it's time once again for the Express Block.
The Express Block, brought to you by Options Express by Charles Schwab. Options Express by Charles Schwab lets you trade where and when you want for every level of trading. From advanced charting, free daily trading ideas, and free educational resources. Options Express by Charles Schwab is the online broker for all traders. Best of all, Options Express by Charles Schwab lets you trade stocks, options, and futures all in a single account on powerful yet easy-use trading platforms, including mobile devices. Visit optionsexpress.com for your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
All right, listeners, this is indeed the portion of the show where the Viceroy takes the reins. I get to take a bit of a rest. Mr. Viceroy, you said it was pretty much an A-day, lighten up the old tape. What else caught your eye? What else was happening over there in the land of OX by Charles Schwab today?
Well, as we recap, the A-name's trading and people just buy in vol. The amount of buying that's been going on in vol is just amazing, and it's lopsided to the upside. But I thought I would also take a couple minutes and revisit a couple product introductions here at OX. And one that we've talked about a bit is Idea Hub on Schwab Mobile. Has been released now for a couple weeks, and clients are embracing it, which is exciting on many levels. But another thing we've talked about, which kind of got moved to the back burner, got nudged almost to the front burner this morning, and that's Idea Hub for futures options, which actually has been ready for a while. But as we integrate the two companies, futures is an area where we here at OX have been really strong in futures and futures options. And beginning next week, we'll be building the internal education for futures and futures options. So that's exciting because as the Hub family kind of expands out, futures being the next step, but we're starting to build the internal education on that. That means hopefully the target date, the X on the calendar, will go up shortly for when that will be released. So we're really looking forward to that. Kind of a quiet day trading, as we've talked about. A lot of stuff mostly unchanged. But the tone was good. We closed higher and tone was good. So it was a good day overall.
We're adding a lot more futures options content to the network and to the website, and there certainly is a paucity of quality information and analysis on that side of the fence. So the more we can see, the more analysis, the more education, the more ideas we can see popping up in the futures options realm, I think the better it will be for all of us, because right now there just clearly is not enough, certainly not enough to meet the demand out there for people who want to know more about these markets, who are coming to them after having traded things like GLD and SLV and other products, and now probably want to graduate to the next level. They want to pick up some of the larger type contracts, get a little bit more leverage, a little bit more action in their account, a little bit more exposure to the products they want to trade. Something like Idea Hub for futures options, I think, would go a long way to satiating that demand and to appeasing that audience, which we know is growing by leaps and bounds every day. All right, thank you for that. Mr. Viceroy, as always. And now it's time for us to keep on rolling right on into our next segment, the strategy block.
It's time to dispense options, wit, wisdom, and education. It's time for the strategy block.
All right, listeners, you know what time it is. It's time for Uncle Mike to descend from the mountain, stone tablet, smoking jacket, and perhaps bubble pipe in hand to dispense some options, wit, and or wisdom. Uncle Mike, we set it up pretty easy for you today. We were touching on ratio spreads a little bit earlier in the show, in the odd block to be specific. It seems like a good time to perhaps dive into those a little bit again, give our listeners a bit of a refresher, a bit of a review of what you can do with ratio spreads, why they're so interesting, and also perhaps why they teeter on a little bit of dangerous as well, a little hint of danger in them as well. Take it away, Uncle Mike.
Well, in order to do the ratio spread, I'm going to have to put on my As Seen on TV pitchman cap. Hi, my name is Mike Tucson. I'm here today to tell you about the ratio spread. Do you ever get frustrated with a cover? Okay, I can't do that. I'm sorry. The ratio spread. What we talked about today with Apple earlier was the 1x2 vertical ratio spread. And that would be an example of where, let's say, XYZ stock is trading at 50. You buy the 50 calls for $2, and you sell the 55 calls for $1. However, you own the stock as well. So you're long 100 shares of stock. You then buy an additional call option. And to finance the cost of that call option, you sell 2 out-of-the-money calls. Now, does that make you naked? No, not at all. The first call is hedged by the stock itself. It's just an old-fashioned covered call. And the second call is hedged, or it's covered, I should say, by the call itself, which creates a bear call spread. So the gist of it, let's just talk about from an expiration day risk standpoint. If the stock stays the exact same, the only loss you have is the commissions. If the stock goes down, the only loss you have is on the stock itself. And if the stock goes up, based upon expiration day risk graph, assuming you hold this till expiration, you will actually get double leverage between 50 and 55. So you're getting double leverage for no additional cost. That's the benefit of this. Now, let's look at the full story. Let's talk about how to handle a trade like this if you're planning on getting out of it before expiration, which 100% of all ratio spreads with which I've done, both calendar ratios, vertical ratios, and any type of ratio, I've never held on to anything until expiration. Something to look at. Oftentimes when you do a 1x2 ratio spread, it will be a slightly negative delta trade, not the stock itself, but the ratio spread. So let's say you own the stock and then just do the trade with which I had mentioned. A lot of times going into the trade, you'll have 100 deltas, but once you make that trade and slap on the ratio spread, you may have 90 or 80. You may have less deltas because of the trade. And the reason is that a lot of times the, quote, 55 calls that we were using in our fantasy example here will have high enough of a negative delta. There'll be more negative deltas in those calls than positive deltas in the at-the-money calls. And think about it for a second. Let's say that most at-the-money calls, let's say, traditionally are around a 50 delta. You're buying an additional 50 deltas at the money. Now, out of the money, let's say that those 55 calls have just a 26 delta. Well, remember, you're selling 2 of them. So if they just have a 26 delta or greater, then that makes for a 52 delta, which is negative. And that's going to create a negative delta. A lot of times it'll be a little bit more than that. But once again, this depends on a lot of different things. So the first thing to remember when doing a ratio spread is that if you've ever had that frustration to where your covered call goes in the money and you're pulling your hair out and thinking, good gosh, why didn't I just own the stock? I hate covered calls. These are just horrible things. Plan on getting that frustration as well when doing a ratio spread of some sort. It exists. It's there. It's going to happen because of the fact that there's still time decay in the short calls with which you sell. That's one thing to remember. The other thing to remember is the fact that technically you are negative deltas on this. Now, I knew a guy that was a futures broker a few years back. And what he used to do is he was so fascinated by this ratio spread, and he was actually a pretty good futures trader. He'd been in the business for a ton of years, and he was really very good with futures, but he wanted to delve into options a little bit. So he decided to start this with ratio spreads. He's like, good guy. And what he would do is, let's say that he was bullish on corn or wheat, coffee, cocoa, sugar, whatever. He would do this without owning the underlying. So basically, he would buy a call option and then sell 2 more call options against it, in the hopes that the futures contract would expire, or these options contracts would expire somewhere in between in this ratio spread. And so his rationale is like, you know what? I've been trading for a bunch of years, and who ever heard of being too right? The underlying going your way that much to where it's going to hurt you. And well, needless to say, he had a very brief ratio spread career. I think he did a few of them for his clients, and then he quickly switched back to doing what he knew and was good at, and just sticking to the futures contracts. If you're doing this without owning the underlying, folks, you can be too right. And if you are too right, then you're wrong. So when doing so, one thing that I would recommend doing is, this is something to where there's a lot of moving parts to a ratio spread. I'd highly recommend doing this in a paper trade account before actually doing this with real money, because there's a lot of different situations that can come up when doing a ratio spread, and you need to be ready for them. You need to be ready to deal with different implied volatility issues that could come up. You need to be ready to deal with if the stock goes your way, whatever the case may be. Ratio spreads can be a great trade, but you need to have a feel for how they would work. Now, a lot of times when people like to use ratio spreads, as Mark was talking about earlier in the show, it's as a stock repair strategy. We've all heard of the concept of buying on the way down, or dollar cost averaging to lower the basis. Let's say you bought the stock at 60, stock goes down to 50, and you have 100 shares of it. Well, if you buy an additional 100 shares, then the average price goes down to 55. And that way, if the stock goes back to 55, you're at break even. Well, a lot of times what people do is they'll put on a ratio spread, and that way you can have that type of leverage for not putting on any additional capital. That's one way with which people use this strategy. And also another way, as we kind of described earlier, this can be like a profit enhancement, meaning that you're looking to get some type of double leverage based upon some type of a ratio spread. Now, the double leverage won't kick in until time decay comes out of the short options. So that's one thing with which you have to remember as well. So long story short, I think this is a great trade. I think it has a lot of possibilities. I really like the strategy. I use it very frequently myself, although I haven't in recent months, but I have used this many times throughout my career. But you really, really, really need to understand all the moving parts that exist in this strategy. And once again, if you've never done it before, this is one that I definitely recommend paper trading first.
You know, Mike, if I can chime in, please. The 1x2, you talked about, you know, you started to talk about how disappointed many people have been with covered call writing in the last couple of years, low volatility environment. And I know all of us in the options industry kind of like to lean on covered call writing, but I think your point is spot on. I think lots and lots of people in the last 15, 18, 20 months have written covered calls that they, in their heart of hearts, ended up regretting. And I think this 1x2 as an income alternative against stock is something people should look at, because effectively what you do is, yes, you don't take in a credit immediately and you might have a small debit, but what you effectively do is between the 2 strikes, you double your stock holding. Now, I know a couple people are going to scratch their head and say, what? Between the 2 strikes, you double your stock holding. Now, you're capped at the upper strike, so it has some of the frustration that a covered write has when it goes up. But I think it's a trade that even an income-oriented investor should look at. And not only is a remedy trade, not only the 1x2 repair, but you know, we should talk a lot about the 1x2 repair when we get some time, especially in cash-settled instruments, especially on things like spiders and the Russell ETF. But I think it's an outstanding strategy. And your point about paper trading it to understand it, I think that's critical, because near expiration, you got to make a decision. It's not a trade you can autopilot. But I think the reality that many covered writers are disappointed is something we don't talk about enough. And B, here's a strategy. If the account is approved for covered writing and spread trading, which is not a big leap, because it's not a leap to nakeds, because the second option isn't naked. I think is even something an income-oriented investor should look at. The big trade today in Apple looks to me like somebody is trying to double their payoff in between the two strikes. So they're betting on, a double or a triple, but not a home run. And in that case, I think it's a brilliant trade. I think, and I know this is a soapbox issue, but I think if the industry ever delivered a cash-settled equity option, the volume in that 1x2 trade alone would probably lift volume a couple percentage points in the industry.
I like it. Good stuff. Unfortunately, we have to leave it there because it's time to roll on to our final segment, Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, listeners, this is, of course, the portion of the show where we break down what we're watching, what we're keeping an eye on for the rest of this trading week. A lot of data on the horizon. Of course, we got data coming in from U.S., Europe, even some Chinese data hitting the market this week. On Wednesday, we got ADP, their old job growth. Thursday, weekly jobless claims. But, of course, the big daddy here, domestically at least, is the non-farms on Friday. A lot of people watching that. Of course, we mentioned earlier, we didn't mean to confuse you with all of our joking listeners, but next week, of course, is the big Apple 7-for-1 stock split on June 9th, next Monday. So if you're trading Apple, I know a lot of you are, plan accordingly. You make sure you know how that stock split is going to go forward, how it impacts your symbols and your strikes, so there's no surprises in store for you on Monday. And of course, we have the big WWDC this week as well, so usually some movement coming out of that event as well. Analogous to an earnings call in many respects. A lot of interesting stuff on the horizon potentially there, so if you got a lot of gamma on in Apple, you want to pay attention to that as well. Since we're talking Apple, Uncle Mike, take us home. What else are you watching for the rest of this week, sir?
Just pretty much what you had said. Once again, I'll remind everyone that never in the history of the entire stock market has there ever been a better time to sell any of your S&P holdings. With that in mind, I do also want to mention that I still am overall bullish for the rest of the year. So my moral to the story, folks, is prepare for a pullback, but you can continue to ride the upside, and you can do it with these cool products called options. Highly recommend looking into them.
Mr. Giovinazzi, what are you watching for the rest of this week, sir?
The same stuff. I'm actually going on vacation on Wednesday for 3 days. Sebastian is releasing me from duty for 3 days, so I will be. Non-farm payroll. That's about it. And earnings are out. I mean, this is kind of a slow, slack time here in June. We got a couple more, but there's some economic data. The data today was okay. Most of it seems to be like 60-40, 60 of it's okay, 48% of it's ho-hum. So, but I think we're going to have a lot more slack like we saw today. And all that slack means that it's going to be effort for volatility to go higher. That's all. We're going to need a reason. And that reason will have to be a significant pullback.
All right, take us home. Mr. Alex, what are you watching for the rest of this week, sir?
Macro, and I know I sound like a broken record, but the 10-year, our 10-year, the German 10-year, the Japanese 10-year, they all had vol come back into them today, and they all declined a bit, but they all had realized moves today in the 25 to 30% area. VIX, how can you not be watching VIX? And I know what all the historical data says, and a lot of the historical data only goes back to the actual trading. We had simulated VIX data going all the way back to the beginning of index trading at the SIBO, and there were lots of 6 and 7 numbers. it's a cottage industry when the S&P gets to a new high and the VIX gets to a new low, for everybody to say, you're going to correct. And we talked about this. I was taught at Merrill Lynch years ago, always be long-term bullish, but say, look, a 5 to 10% correction is possible at any time. I think VIX is going to go lower. I think we're going to continue to go up. I'm now in the camp that I think rates will not pop for a while. And I like this market. I would continue to buy. I think if you do get a dip, I would buy the quality dividend names. That's what everybody's been doing. And I would continue to do that. And I think we could easily see 2,000 on the S&P and 17,000 on the Dow. Will there be bumps along the way? Sure there will. And every time there's a bump, if you spend 5 minutes watching CNBC or Bloomberg, they have somebody come on who says it's the end of the world. And 3 days later, we're at a new high. So I think that's the market we're in.
All right, listeners, that's going to do it for the Around the Block segment. It's also going to do it for this episode of the Option Block. But before we go, as always, I like to check in with each of my cohorts here on the old All-Star panel, see what they're working on, see what they're cooking up that may interest you. Unfortunately, we lost the Rock Lobster. He had to run. But if you're interested in all the stuff they have cooking up over there, their gold course, their chat, and all the other cool stuff, surf on over to optionpit.com. You can check it on out for yourself and let them know, hey, you heard them on the Option Block. They love to hear that kind of stuff. It makes their egos grow even bigger. I'm just kidding. All right, and Uncle Mike Tusaw, what's coming down the pike from the old webinar choo-choo?
Well, webinar choo-choo is going to be on hold for a while, but we have the in-person airplane that's getting ready to take off in the near future. Probably in the next couple weeks, we will have some more information on it.
All right, and Mr. Alex, what's coming down the pike in OX education?
Couple events. Our June live event has not slotted yet, but as soon as we slot that, I'll get it up. Wednesday, June 4th, David Hightower doing a webinar with us, what's hot, what's not in futures. And David has some real strong views on gold. So it's a real interesting listen. June 5th, we'll be doing advanced order features and walk limit. And hopefully soon, I will be doing Idea Hub for futures options. So I'm looking forward to that. And I hope our futures traders are as well.
All right, and on behalf of Uncle Mike and the Viceroy and the Rock Lobster and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. Make sure you send in those questions. We love to have a lot of listener feedback for our Thursday show. And, of course, we'll see you next time right here on the Option Block.
The Option Block was brought to you by Options Express by Charles Schwab. Don't spend time worrying about your broker at Options Express by Charles Schwab. Security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets. Established financial stability. Options Express by Charles Schwab lets you trade with confidence. Stocks, options, and futures all in one account. Trade with a specialist. Visit www.optionsexpress.com to open your free account. Options Express by Charles Schwab is a member of FINRA, SIPC, and NFA.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.